All right, so are you ready to dive into intelligent investing?
Always ready.
You came to the right place.
Yeah.
We've got a stack of material on Benjamin Graham,
Oh, wow.
including excerpts from his classic, The Intelligent Investor,
All right.
ready to unearth some wisdom.
Let's do it.
Ugh.
It's fascinating to revisit Graham's work, especially,
Yeah.
The Intelligent Investor was first published back in 1949.
Wow.
It's incredible to think that it's still considered like the cornerstone of value investing all
Yeah.
these years later.
It really is. The fact that we're talking about it today just proves that his ideas have stood the test of time.
Mm-hmm.
We've got a mix of Graham's original text and commentary from Jason Zweig,
Oh,
who
cool.
updated the book for a modern audience.
Okay.
So our goal today is to pull out the most important concepts from The Intelligent Investor and see if they still hold up in today's market.
It's almost like we're time traveling
Exactly.
to see if these investing principles transcend different eras.
So let's start with the foundation. What exactly did Benjamin Graham mean by an intelligent investor?
Yeah.
Because it's not just about being a math whiz.
Right. You're absolutely right. He actually says that being an intelligent investor is a trait more of the character than of the brain.
Huh.
He was much more interested in character traits than raw intellect.
Oh, that's interesting. So what kind of traits are we talking about here?
Patience, discipline, a thirst for knowledge,
Okay.
and maybe the most important one, emotional control.
Okay.
Yeah.
So it's like he's describing a Jedi master of investing.
Yeah.
Like inner peace amidst the chaos of the market.
That's a great way to put it because
Yeah.
you need that inner peace to avoid getting swept up by the market's mood swings. And that actually leads us to another core concept from Graham.
Okay.
This very clear distinction
Yeah.
he makes between investing and speculation.
Okay, so not all buying and selling of stocks is created equal in Graham's eyes.
Absolutely not. He defines investment as an operation which, upon thorough analysis, promises safety of principal and an adequate return.
Okay.
Anything that falls outside of that,
Yeah.
anything driven by emotions and short-term market fluctuations, is speculation.
And speculation, as we know, can be very dangerous. Didn't Graham himself have kind of a cautionary tale about this?
He did. Early in his career, he made a 250% return
Wow.
on the very first day of trading for a company called Savold Tire.
Oh, wow.
The automotive industry was booming,
Okay.
and everybody was clamoring to get a piece of the action.
So talk about a quick win.
Yeah, but there's a twist.
Yeah, there's got to be a twist.
Just a few months later, Savold Tire was exposed as a fraud,
Oh, no.
and the stock became completely worthless.
Wow.
He had a harsh lesson in the dangers of getting caught up in market hype.
Oh, man, that must have been a serious reality check for him.
Oh, yeah.
So how did that experience shape his view of investing?
It really solidified his belief in thorough analysis and intrinsic value. It's not about chasing quick profits.
Okay.
It's about understanding the underlying business.
Mm-hmm.
And that's where his famous margin of safety comes into play.
Okay, let's talk about that margin of safety. I've heard that phrase thrown around a lot, but what does it actually mean in practice?
It's essentially a buffer zone, buying assets for significantly less
Okay.
than their intrinsic value, giving you a cushion
Okay.
against market volatility.
Mm-hmm.
Think of it like this. If you know a business is truly worth $100,
Yeah.
but you can buy it for $50.
You're basically getting a 50% discount.
Exactly.
So you have some room to maneuver even if things don't go perfectly.
Exactly. And Graham actually practiced what he preached.
Okay.
He found that Northern Pipeline Car was trading for $65 a share,
Okay.
but they held at least $80 per share
Wow.
in high-quality bonds.
So he was essentially getting their entire operating business for free.
Pretty much.
That's incredible. So he was basically buying dollar bills for 50 cents. Finding those opportunities must take a lot of research and patience.
It does, but the rewards can be significant.
Yeah.
And that ties into another key aspect
All right.
of Graham's philosophy, how to deal with the inevitable ups and downs of the market.
Yeah, because as we all know, markets don't just go up in a straight line.
No, they don't.
That's where emotional discipline comes in again, right? Not letting fear or greed take the wheel.
Absolutely. Graham saw market fluctuations, even severe ones,
Yeah.
as an inherent part of the game.
Okay.
He even highlighted the 1969-70 bear market, which saw a 35% drop in leading stocks.
Wow.
Huge decline. But he stressed that an intelligent investor shouldn't panic during these downturns.
So instead of like selling off everything in a frenzy,
Right.
You're actually looking for opportunity.
Exactly. Those downturns can expose undervalued assets
Okay.
that others are too scared to touch.
Yeah.
It's about having a different perspective.
Hmm.
Being greedy when others are fearful, as Warren Buffett famously said.
That takes a lot of courage.
That is.
You know, like going against the herd mentality.
It does. And it brings us to another concept
Okay.
that Graham emphasized, diversification.
Okay.
It's like that old saying, don't put all your eggs in one basket.
Right. I can see how that ties into managing risk. If one investment goes sour, it doesn't wipe out your entire portfolio.
Right. Jason Zweig actually added some modern context to this
Right.
in his commentary.
Yeah.
He talks about how diversification increases your chances of owning what he calls super stocks.
Okay.
Companies like Dollar General and UST Inc.,
Mm-hmm.
which weren't like the obvious high-growth picks,
Right.
but ended up delivering huge returns.
So you're saying you don't need to perfectly predict which companies will become the next Amazon to be successful.
Exactly.
Okay.
Diversification helps you capture those unexpected winners
Yeah.
without having to gamble on individual stocks.
Right.
It's a strategy for both protecting your downside
Okay.
and potentially hitting those home runs.
That's a really interesting point. So diversification,
Yeah.
emotional discipline,
Mm-hmm.
and understanding intrinsic value
Yeah.
seem to be like the building blocks
Yeah.
of Graham's approach.
They are. And he recognized that not all investors are the same.
Okay.
He broadly categorized them to two types,
Okay.
the defensive investor and the enterprising investor.
Oh, hold on. Before we jump into that, I want to make sure we're all on the same page.
Okay.
When he says defensive, he doesn't mean being scared of the market, right?
No, not at all. It's more about the level of effort
Okay.
and involvement you're
Yeah.
willing to put in.
Yeah.
The defensive investor, sometimes called the passive investor,
Okay.
prioritizes safety and simplicity.
Okay.
They're looking for a solid portfolio that doesn't require constant attention
Mm-hmm.
and delivers steady returns over time.
So it's like the set it and forget it approach to investing.
You could say that,
Okay.
but it still requires choosing the right investments and understanding your risk tolerance.
Okay.
Now, on the other side, you have the enterprising investor or the active investor.
Okay.
They're willing to put in more time and effort
Yeah.
researching and analyzing individual stocks.
So they're the ones actively looking for those undervalued gems, those diamonds in the rough
Right.
that the market has mispriced.
Precisely. They enjoy the challenge of digging into financial statements
Okay.
and uncovering hidden value.
And it sounds like both approaches have their merits.
Yes.
And both can be successful.
Absolutely.
Yeah.
Graham emphasized that neither approach is inherently superior.
Right?
The key is choosing the one that aligns with your personality,
Okay.
your time commitment,
Yeah.
and your individual goals.
So it's about being self-aware and choosing the path that fits you best.
Yeah, that makes a lot of sense. So now that we've kind of laid the groundwork, let's dive into how Graham actually approached finding those undervalued stocks.
Let's get into it. All right, so we've talked about Graham's core investing principles, but how did he actually go about finding those undervalued companies? What did he look for?
Yeah, so he called his approach value investing.
Okay.
And it was all about looking beyond the hype
Yeah.
and digging into a company's financials
Mm-hmm.
to determine its true worth.
Mm.
He loved finding bargains,
Yeah.
companies that were overlooked or even dismissed by the market.
So he wasn't chasing after the hottest trends or, the most glamorous industries.
Not at all.
Huh.
In fact, he often favored companies that were considered boring or out of favor.
Only.
He looked for companies with low price-to-earnings ratios,
Okay.
strong financial strength, a history of paying dividends,
Okay.
signs of stability and value that others might miss.
Why the emphasis on low price to earnings ratios? Isn't a high PE ratio usually seen as a good thing?
Oh,
A sign of growth potential?
you'd think so, but Graham was a contrarian.
Okay.
He saw those high PE ratios as a sign that the market was already overly optimistic about a company's future,
Yeah.
often pricing in growth that might never materialize.
So he was looking for companies that were underappreciated by the market,
Exactly.
where the price didn't reflect the true value of the underlying business.
Exactly. He believed that by carefully analyzing a company's financials,
Mm-hmm.
you could uncover these hidden gems.
Yeah.
Companies that were trading for less
Yeah.
than they were actually worth.
So he was like a financial archaeologist,
Yeah.
digging through all the layers to find these hidden treasures.
That's a great analogy. And to illustrate this, he often used case studies,
Okay.
comparing companies that might seem similar on the surface,
Mhm.
but had vastly different underlying values.
Yeah.
One example that he highlighted was the comparison between National General and National Presto.
I remember that one from the material I sent you. What made this company such a good case study?
Well, both companies operated in seemingly similar industries,
Okay.
but their financial situations were drastically different. National General was a big, flashy conglomerate involved in insurance publishing
Mm-hmm.
and other businesses.
Okay.
It had a much higher price-to-earnings ratio
Mm-hmm.
than National Presto,
Okay.
which was a more traditional manufacturer of housewares and small appliances.
So even though they might have looked comparable at first glance,
Yeah.
a deeper dive into their financials
Yeah.
revealed a huge discrepancy in their valuations.
Precisely.
Yeah.
And Graham pointed out that this difference was largely due to market perception.
Okay.
National General, with its complex conglomerate structure,
Yeah.
was attracting a lot of speculative interest,
Mm-hmm.
which was driving up its price.
Well, National Presto, being a more straightforward, maybe even boring company,
Right.
was kind of flying under the radar.
Exactly. And this is where Graham's concept of Mr. Market comes in.
Oh, yeah.
This idea of personifying the market as an emotional,
Yeah.
often irrational being.
Okay, I've heard about this Mr. Market, but how does this character actually fit into Graham's investing philosophy?
We'll think of Mr. Market as an unpredictable neighbor who's constantly knocking on your door,
Okay.
offering to buy your stocks or sell you his.
Right.
Sometimes his prices are reasonable,
Mhm.
sometimes they're completely outlandish.
So he's driven by his moods,
Hmm.
not by logic or careful analysis.
Exactly. And Graham argues that instead of letting Mr. Market's mood swings
Mm-hmm.
dictate your investment decisions,
Yeah.
you should use his irrationality
Okay.
to your advantage.
Okay, wait. So how do you actually exploit Mr. Market's irrationality? It sounds a bit abstract.
It starts with recognizing that Mr. Market's prices
Yeah.
don't always reflect a company's true worth.
Okay.
Sometimes he's overly pessimistic,
Mm-hmm.
offering you great companies at bargain prices.
Okay.
Other times he's overly optimistic, creating bubbles that are bound to burst.
So the key is to have your own independent assessment of what a company is worth.
Exactly. That's where thorough analysis
Right.
and the margin of safety come in.
Yeah.
You need to know what a business is truly worth.
Mm-hmm.
So you can recognize when Mr. Market is offering you a steal
Okay.
or trying to sell you fool's gold.
So when Mr. Market is panicking
Right.
and selling off great companies at a discount,
Yeah.
you have the confidence to buy knowing you're getting a good deal.
Exactly. You're buying when he's fearful
Yeah.
and conversely when he's euphoric,
Yeah.
driving prices to unsustainable levels.
Mm-hmm.
You're prepared to sell. You're selling when he's greedy.
That's brilliant. So you're not ignoring Mr. Market completely.
Right.
You're paying attention to his offers,
Right.
but you're not letting him control your decisions. You're in the driver's seat.
Precisely. You're using his irrationality to your advantage,
Okay.
not letting it lead you astray.
Now, this reminds me of something else we talked about earlier, this idea of super investors. Didn't Graham dedicate a whole appendix to analyzing these investors who consistently beat the market?
He did, and it's fascinating.
Yeah.
Because these super investors, including Warren Buffett,
Yeah.
had different styles,
Yeah.
different areas of focus,
Mm-hmm.
but they all shared a common thread.
Okay.
They all applied Graham's principles,
Okay.
focusing on buying businesses, not stocks,
Yeah.
based on their intrinsic value.
So it wasn't about following a specific formula or mimicking someone else's strategy. It was about internalizing those core principles
Exactly.
and applying them in your own unique way.
Exactly. And one of the anecdotes that Graham shared that really stuck with me
Okay.
was about Warren Buffett's purchase of the Washington Post Company
Mm-hmm.
back in 1973.
Okay.
The company was trading for just $80 million,
Wow.
but its assets could easily have been sold for at least $400 million,
Yeah.
potentially much more.
So Buffett saw this massive discrepancy
Like, cool.
between the market price and the intrinsic value of the business. He was basically buying $1 for 20 cents.
Exactly. And that's the power of Graham's approach.
Yeah.
It's about identifying those situations
Yeah.
where the market is mispricing a
Yep.
business,
Mm-hmm.
creating opportunity
Yeah.
for those who have done their homework.
It's like finding a hidden oasis in the desert. Those opportunities might not be easy to find, but they're out there for those who are willing to look.
And that's why Graham stressed the importance of patience.
Yeah.
He understood that investing is a long game
Mm-hmm.
and that true success requires disciplined persistence and the ability to withstand the inevitable ups and downs of the market.
So it's about having a long-term vision,
Exactly.
not getting distracted by the short-term noise.
Right. And Graham also emphasized the importance of continuous learning.
Okay.
He believed that investors should always be striving to expand their knowledge, staying up to date on market trends, economic conditions, and company developments.
So it's not enough to just learn the basics and then coast.
Right.
You need to be constantly evolving and adapting to a changing world.
Absolutely. The market is dynamic.
Yeah.
And so should our understanding of it be?
All this talk about market fluctuations and emotional discipline makes me think about something else Graham emphasized: the importance of dividends.
Oh, he was a big believer in dividends.
Okay.
He saw them as tangible evidence
Okay.
of a company's profitability and its commitment to rewarding shareholders.
So it's not just about the potential for the stock price to go up.
Right.
You're also getting a steady stream of income from the dividends.
Exactly. And those dividends can provide a cushion during market downturns.
Okay.
Even if the stock price is bouncing around,
Yeah.
you're still receiving that regular income,
Yeah.
which can help you weather the storm.
That makes a lot of sense. It's like having a safety net built into your investments.
Right. And it speaks to Graham's focus on safety and stability.
Yeah.
He knew that investing could be an emotional roller coaster.
Mm-hmm.
So he looked for ways to minimize the psychological impact
Okay.
of those ups and downs.
That ties back to his idea of the intelligent investor, someone who can stay calm and rational even when everyone else is losing their heads.
Absolutely.
Right.
It's about focusing on the fundamentals, not getting caught up in the market's mood swings.
So how did Graham suggest investors actually build their portfolios? Did he have specific recommendations?
He did. And as you might expect,
Yeah.
his suggestions vary depending on the investor's goals, risk tolerance, and time horizon.
Okay.
For the defensive investor, the one prioritizing safety and simplicity,
Yeah.
he suggested a low-maintenance portfolio consisting mainly of bonds
Okay.
and a diversified selection of large, well-established companies.
So it's about creating a solid foundation, a portfolio that can weather market storms and deliver consistent returns over time.
Exactly. It's not flashy,
Yeah.
but it's designed for stability and peace of mind.
Yeah.
Now, for the enterprising investor, the one who enjoys the challenge of research and analysis,
Right.
Graham recommended a more active approach.
Okay.
So they're the ones digging into financial statements,
Yeah.
hunting for those undervalued gems.
Right.
He encouraged them to explore different industries, consider smaller companies,
Okay.
and be more opportunistic in their buying and selling.
But even for the enterprising investor, those core principles still apply, right?
Absolutely.
Diversification, margin of safety, understanding intrinsic value.
Yes.
Those are universal.
Absolutely. Those are the pillars of intelligent investing,
Yeah.
regardless of your individual style or approach.
Now, I know Graham wrote The Intelligent Investor decades ago,
Yeah.
but some of his ideas seem especially relevant today. For example, his thoughts on technology companies and how to evaluate them. He even dedicated an appendix to that topic.
Yeah, he did. He recognized that technology companies often have very different business models
Okay.
and growth trajectories
Yeah.
than traditional companies.
So the old rules might not apply in the same way.
Exactly. The rapid pace of innovation in tech
Yeah.
creates both incredible opportunities
Yeah.
and significant risks. He stressed the importance of understanding the technology itself,
Okay.
the market dynamics,
Mm-hmm.
and the competitive landscape.
So it's not enough to just jump on the bandwagon of the latest buzzword. You need to really understand what you're investing in.
Exactly. He cautioned investors against overpaying for tech stocks,
Okay.
especially those with unproven business models or excessive hype.
Yeah.
It's about separating the substance from the hype,
Yeah.
looking for companies with real earnings power, not just promises of future riches.
And that brings us to one of Graham's, I think, most important insights.
Yeah.
One that's incredibly relevant in today's world of social media and instant information: the impact of market psychology.
It's so easy to get swept up
I know.
in the fear and greed that
Yeah.
drives market sentiment,
Yeah.
especially when you're bombarded with news and opinions 24/7.
So how did Graham suggest investors navigate this psychological minefield?
He believed that the key was to have a well-defined plan,
Okay.
a set of principles that you stick to, regardless of the market's mood swings.
Mm-hmm.
And that plan should include ignoring the noise
Okay.
and focusing on the long term.
Yeah.
Remember, Mr. Market is emotional,
Yeah.
but you don't have to be.
That's easier said than done, though, right?
For sure.
It takes a lot of discipline to stick to your plan when everyone around you is panicking
Right.
or getting euphoric.
It does.
Uh,
But that's what separates the intelligent investor from the speculator.
mm-hmm.
The intelligent investor has a strategy
Mm-hmm.
and the emotional fortitude to stick to it.
And as Graham emphasized, even the most intelligent investors can make mistakes. It's about being humble, recognizing that the market can be unpredictable, and learning from your experiences.
Exactly. He believed that the best way to manage risk
Yeah.
is to diversify your portfolio,
Yeah.
invest for the long term, and focus on companies with strong fundamentals.
Those are principles that have stood the test of time.
They have.
And they're the foundation of building a portfolio that can weather the storms and deliver consistent returns over the long term.
Great.
Speaking of building a portfolio, Graham also offered specific guidance on how to analyze financial statements right.
He did.
He wanted to empower individual investors to make informed decisions. He did. He believed that understanding a company's financial statements was crucial for making intelligent investment decisions. But he also recognized that those statements
Right.
could be complex
For sure.
and even misleading at times. It's like learning a new language, you
Yeah.
know? Once you understand the vocabulary and the grammar,
Yeah.
you can unlock a wealth of information.
A whole new world.
Exactly. So, how did Graham suggest investors approach this? What were some of the key things he looked for when analyzing a company's financial statements?
Well, he always emphasized looking for red flags.
Okay.
Anything that might raise concerns about a company's financial health
Yeah.
or its accounting practices,
Mm-hmm.
excessive debt, declining earnings, unusual or inconsistent accounting practices.
Right.
These were all warning signs to him.
Yeah. So it's about being a bit of a detective, you know, looking for clues that might reveal a different story
Right.
than the one the company is presenting.
Exactly. It's about going beyond the headlines.
Yeah.
And digging into the details.
Okay.
He also recommended comparing a company's financial statements over time
Okay.
to spot any trends or changes.
Mm-hmm.
Are earnings growing steadily? Is debt increasing?
Yeah.
These patterns can tell you a lot about a company's trajectory.
So it's like checking a company's vital signs,
Very
looking
check.
for any signs of weakness or instability.
That's a great way to put it.
Yeah.
And he also stressed the importance of comparing a company's financials
Okay.
to those of its competitors.
Right.
How does it stack up in terms of profitability, efficiency, and financial strength?
So it's not just about looking at the numbers in isolation. It's about understanding the context, the industry dynamics,
Yeah,
and the competitive landscape.
precisely.
Yeah.
And Graham provided investors with a toolkit of ratios and metrics to make those comparisons and identify potential investment opportunities.
Yeah.
These tools, like the price-to-earnings ratio or the debt-to-equity ratio,
Hmm.
are still widely used today, even in our age of sophisticated algorithms
Yeah.
and big data.
It's a testament to the enduring power of his ideas.
Right.
The fundamentals still matter.
They really do. And I think one of the most important things Graham emphasized
Yeah.
was the need for intellectual honesty.
Okay.
It's about being willing to challenge your assumptions,
Mm-hmm.
to question the conventional wisdom,
Yeah.
and to be critical of your own analysis.
So it's not about blindly following formulas or gurus. It's about thinking for yourself,
Exactly.
developing your own independent judgment.
Exactly. He wanted to empower investors
Yeah.
to become independent thinkers, not passive followers.
Okay.
And he believed that this intellectual independence
Mm-hmm.
was essential for navigating the complexities of the market
Yeah.
and making sound investment decisions.
It's all starting to come together now. The importance of character traits, the discipline to stick to your principles, the willingness to do your homework, the understanding of market psychology, the focus on intrinsic value. It's all connected.
It is. It's all part of a holistic approach to investing,
Yeah.
one that recognizes the importance of both analytical rigor
Mm-hmm.
and emotional intelligence.
Yeah. So as we wrap up our deep dive into the intelligent investor, what's the key takeaway for our listener? What's the one thing they should remember as they embark on their own investment journey?
I think the most important lesson is this. Intelligent investing is not about getting rich quick.
Yeah.
It's about building a solid foundation for long-term financial success.
It's about being patient, being disciplined, and staying focused on the fundamentals,
Right?
even when the market is testing your nerves.
Exactly. It's
Yeah.
about being a student of the market,
Yeah.
constantly learning and evolving and being willing to challenge your assumptions.
Yeah.
It's about remembering that the most important investment you can make is in yourself.
Beautifully said. We've covered a lot of ground today, from the distinction between investment and speculation to the power of diversification, from the concept of Mr. Market to the importance of analyzing financial statements. And through it all, we've seen the enduring wisdom of Benjamin Graham's timeless principles.
It's been a fascinating journey revisiting these ideas and seeing how relevant they remain even in today's complex and ever-changing market.
So to our listener, we hope this deep dive has given you a framework for thinking about investing, for approaching the market with a sense of clarity and purpose.
And most importantly, we hope it's inspired you to embark on your own journey of becoming an intelligent investor.
Until next time, happy investing.